Well, 50 years ago today, August 15th, 1971, Nixon took us off the gold standard, okay, which was a momentous thing. And really started a lot of things rolling that bring us to where we are today, where the value of our dollar has pretty much disappeared. Inflation is starting to get out of control. The middle class has disappeared. Now, what is the gold standard? Let's talk about what it is, all right, before we talk about him doing away with it. Well, the gold standard is a currency measurement system. How do you measure the value of the currency? Well, it uses gold as a way to value money. And it ensures that your currency could always be exchanged for gold. So it used to be you could take $100 and go to the bank and get ounces of gold. At the time, an ounce of gold was let's say $35. So you can get 3 ounces of gold for your money, and that's the way people didn't really do it, but countries did. And it was a way of putting discipline into a country's spending habits. And gold has been used as currency throughout history. I mean, 5,000 years. You go back in the Bible, they're talking about silver and gold coins. And in 1861, the first paper currency was printed, the United States. Now, there was revolutionary, colonial currency, but as far as the United States of America goes, the first paper currency was printed during the Civil War. In 1900, the Gold Standard Act established gold as the only metal for redeeming paper currency. You used to be able to redeem it for silver and gold. So the government would always redeem your money for gold. Now, why would governments do that? Think about it. In the past, people walk around with coins in their pocket or a bag of gold coins or silver coins, which is heavy. If anybody's ever held a 1 ounce gold coin, it's heavy. So if you have 15 of them in your pocket or your bag, it's hard to carry them. Plus, it's easy to be robbed when people see you walking around with a bag of coins. So what the banks did is they say, okay, we'll give you a certificate, in this case a piece of currency, that represents your ownership of gold. So you give us the gold, we'll give you the paper, and whenever you want the gold back, you give us the paper. And the paper was considered as good as gold because it was represented and it was backed by gold. Now, in 1913, Congress established the Federal Reserve. Now, probably one of the most criminal acts in the history of Congress with incredible ramifications and probably unconstitutional. And we've talked about the Federal Reserve in the past. But they said the reason why they established the Federal Reserve was to stabilize gold and currency values in the United States. Now, there was times when we suspended the gold standard in World War I. We suspended the gold standard so the country could print as much money as they needed to pay for military victory. But after the war, countries started to realize that they really didn't need to tie their currencies to gold, and that it may harm the world economy to do so because they couldn't spend the money they wanted to spend. Now, in 1933, in the middle of the Depression, President Franklin Roosevelt closed the banks in response to a run on gold reserves at the Federal Reserve, because countries realized that the dollar was being debased and they didn't want to have their money in dollars anymore, and they were exchanging it for gold. And that was pulling all the gold out of the Federal Reserve. And he closed the banks for 7 days. By the time the banks reopened on March 13th, they had turned in all their gold to the Federal Reserve. They could no longer redeem dollars for gold, and no one could export gold. And on April 20th, a month later, FDR ordered Americans to turn in their gold in exchange for dollars. So basically, it was a criminal act to own gold at that point. And that's how they created the gold reserves at Fort Knox, is by everybody turning in their gold. And soon thereafter, the United States was the largest holder of gold in the world. And you were not allowed to hold ownership of gold except if you had a special license. So once a country goes off the gold standard, it no longer has a discipline where they can't create money if they don't have the gold to back it. And that's a fiat currency system. When you don't have something else representing your currency, like gold in a vault somewhere, then you are what's called a fiat currency. Fiat meaning that no backing. And that allows governments to spend money they don't have, to expand social programs, and all the things that they would be limited to do if they had to spend within their means. You just couldn't have deficit spending. And you couldn't have a trade imbalance. Well, you could, but that was a big problem too, is that the dollar got so strong back in the 30s and even into the 70s, the 60s and 70s, that we were not competitive. Japan, made in Japan, now it's made in China, right? But back in the day, it was made in Japan. And Europe, they were eating our lunch from a trade perspective because their currencies were cheap and they could undercut our products that were much more expensive around the world. So what would happen is these countries would be getting all of our dollars because of the trade surplus they had, and they didn't want the dollars, so they would go and sell the dollars back to the Federal Reserve. In replacement, they would get gold. So what happened is the country's wealth, their gold, would start being sucked out of the country because of a trade imbalance. And think about it, that's the way it should be. If we're spending more money buying foreign products than they're buying ours, well, isn't our wealth going overseas? Well, sure it is. And we were being penalized by that because we were losing our wealth in the form of gold. So if you go and say, okay, we're not tied to gold anymore, then you don't have that problem. You could just keep creating dollars and dollars and dollars and not lose your wealth. You are losing your purchasing power to some extent, but you were losing your wealth because as the gold went out of the country, that means you couldn't have that much money outstanding. You had to cancel currency that was out there and you couldn't issue new ones. Now, there was something called the Bretton Woods Agreement after, in 1944, after World War II. 44 nations met in Bretton Woods, New Hampshire, to develop a new international monetary system, which went on to be known as the Bretton Woods system. And what happens is they tied foreign currencies to the value of the U.S. dollar, making the U.S. dollar the world reserve currency. But again, the dollar was fixed to gold at $35 an ounce. So this was the way the currency system worked for a long time, until 1971. Now, why did Nixon take us off the gold standard? Well, and what he did was very interesting. It was a Sunday night, exactly 50 years ago today. He came on TV and basically laid out what he was going to do. Before that, he had met at Camp David for a number of days with his Federal Reserve chairman, which was Arthur Burns at the time, the new incoming Treasury Secretary, John Connolly, and Paul Volcker, who was not the Fed chairman yet, but was certainly involved in the international monetary affairs, advising the president. So on the afternoon of August 13th, 2 days before he took us off the standard, they met with a lot of high-ranking money people in Camp David. There was great debate on what they were going to do, what Nixon should do. But ultimately what Nixon did, really on the advice of the incoming Treasury Secretary Connolly, he decided to break the Bretton Woods Agreement, and he took the following actions. He directed the Treasury Secretary, to suspend the convertibility of the dollar into gold or other reserve assets, ordering the gold window to be closed so no foreign government could no longer exchange their dollars for gold. Most people have no idea how significant that was. And it freaked out other countries. Because what's the value of having a dollar if we can't convert it to gold? Then Nixon issued Executive Order 11615, the Economic Stabilization Act of 1970, imposing a 90-day freeze on wages and prices to counter inflation. First time we had wage controls. You can't give anybody a raise. And he had price controls. You can't raise the price on anything. And that never works for battling inflation. It may temporarily, but it never works. And this was the first time the government had did that. Now, what was going on with inflation and unemployment at the time that Nixon had to take this anti-inflationary move? Well, the unemployment rate was 6.1%. Not much different than it is today. I mean, it's officially, I think, 5.3, whatever it is. It's higher. We know that. The inflation rate was 5.84% in 1971. Almost exactly what it is right now. We'll talk about inflation in a little while. So things weren't that much different in 1971 for Nixon to do this. He had an import surcharge of 10%, so American products would be more competitive. So this is a trade war now that you're doing this, when you do this. When you tell them any foreign product that comes into our country is going to have a 10% tariff. That's pretty much what Trump was doing last year with Chinese products, right? So he went on television because this was really monumental. And I remember it, believe it or not. I was 11 years old. I don't remember the details of it, but I remember it happening. And I remember my father talking about how monumental this was. And he didn't really understand it, and most Americans didn't. But the fact that he would do a national address on it made it pretty important. So he went on television. He said the following: the third indispensable element in building the new prosperity is closely related to creating new jobs and halting inflation. We must protect the position of the American dollar as a pillar of monetary stability around the world. Now, this is kind of like ironic. The way you're going to keep the dollar as a pillar of monetary stability is to take it off the gold standard? That doesn't make much sense to me. It's just the opposite. In the past 7 years, there's been an average of one international monetary crisis every year. I have directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Now, there's the word temporary. Well, it wasn't temporary. It's still suspended. You can't convert dollars to gold. Now, you can go out and buy gold, but you can't convert it through the banking system. Now, what is this action, which is very technical? What does it mean for you? Now, he's talking to the American people. Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today. The effect of this action, in other words, will be to stabilize the dollar. Well, that wasn't really the case because the dollar shortly thereafter began to decline and has been declining ever since in purchasing power. Now, the American public naively believed that the government was rescuing them from price gouges and from foreign-caused exchange crises. And from a political sense, Nixon's action was a great success. The Dow Jones Industrial Average rose 33 points the next day. Doesn't sound like a lot in today's Dow, but it was the biggest daily gain ever at that point. And newspapers were 100% behind it. The New York Times wrote, "We unhesitatingly applaud the boldness with which the president has moved." But that set off an inflationary spiral that we're dealing with today. And this is also known as the Nixon Shock. The Nixon Shock, which was doing all this stuff. Price controls, tariffs, and more importantly, taking us off the gold standard. So what's the advantage of having a gold standard, and what's the disadvantage of not having it? Well, the advantage is that it provides the ability, it's self-regulating. It stabilizes the economy because you can't spend more than you have. You can't borrow money as easily as you can when you don't have a peg to gold. It discourages inflation. It discourages debt. And it rewards productive nations. Nations that have good production, good competitiveness, good products, gold flows to them, and they become wealthier nations. What's the disadvantage of being on the gold standard? Well, a country's economy is dependent upon how much gold it has. And governments, fixate on keeping their gold because, the nation's worth is based on how much gold they have. And that can cause significant fluctuations in the economy. It can cause recessions and depressions because the government doesn't have the ability to spend money it doesn't have to stimulate the economy. What's happened over the last year and a half? Stimulus, right? Trillions of dollars of stimulus. You couldn't do that under a gold standard. And most likely we would have been in a long, protracted depression because of it, the shutdown of industries and all that. But with a fiat currency, you're able to produce it in mass out of thin air and stimulate the economy and stimulate inflation, which is what we're seeing now, which is the byproduct of doing all that. Will we ever go back on a gold standard? No, I don't think so. I don't think so. It just would be too draconian to most Western economies. They're now addicted to debt and deficit spending. So I don't see that happening. Now, could there be some kind of a gold standard? Yeah, there could be. There could be a peg where a certain percent of a currency is backed by gold, or a basket of currencies that, if you ever heard of special drawing rights, which is a type of currency that moves between nations through the Bank of International Settlements and International Monetary Fund. I don't want to get into that now. It's a little complicated, but gold could be tied to that to some extent. But any kind of peg to gold will be very, very bullish for gold, obviously. And inflation is the price we've paid for what Nixon did exactly 50 years ago today. This week it was announced that the Consumer Price Index jumped 5.4% year over year, which we haven't seen figures like this in probably 20 years. But the thing about inflation right now, it's not the number 5.4%, which is underestimated. It's the rate of growth of inflation, which is growing at a higher rate than ever before. The government said that the CPI increased 0.5% month-over-month basis. Now, John Williams, who calculates the CPI based on the way they used to calculate it in 1980, the last inflation scare we had, says you could add 7 points to that, so you're looking at 12.5% to 13%. Only about 2 percentage points less than the big inflation problem we had in 1980, which caused Paul Volcker to raise interest rates to 18%. Here we have 0. And meanwhile, we have central bankers, namely our central bank, not the least bit concerned, at least not publicly, about what's going on in inflation, and are intent on keeping interest rates at 0 and to continue to print $120 billion a month and finance our deficit, which is just crazy. The day after the Consumer Price Index came out, the Producer Price Index came out. Now, what is the Producer Price Index? This is what manufacturers of products pay for raw materials. So first you have producer price inflation, and then that flows into consumer price inflation because the producers are going to push their increased cost onto the consumer whenever they can. And usually there's a few month delay in that. So after soaring a record high 7.3% year over year inflation in June, the PPI was expected to modestly moderate in July, but it didn't. It actually soared to a new record of 7.8% year over year, up 1% for the month. Now you're talking 8% inflation in producer prices. And again, this is understated, just like the CPI is. And this is going to flow into the final cost of products as we go into the months ahead. So inflation is something we haven't really talked about as a big problem in the United States since 1980 when we had the last inflation. We've had pretty low inflation, at least from what the government says. But you know, even if you have 1.5% annual inflation, prices go up 300% in 100 years. Think about that. And of course, we've had higher than that for a long time. And what it does is it squeezes the middle class because wages do not go up as much as prices do. But we haven't had an extended bout of inflation like this since the Carter administration. And our leaders in Washington have decided that the best way forward is to rapidly create more inflation. They keep using the words transitory, temporary, but it's not. And then at the same time, they talk about borrowing more money, trillion-dollar bills. They passed the infrastructure bill this week, over $1 trillion. Now they have a $3.5 trillion spending bill that has all the stuff they couldn't get into the infrastructure bill. They just keep doing the opposite of what they should be doing. So double-digit inflation. Nobody has to tell you. You know it. You see it. You go to the grocery store. You go to fill up your car. You try to buy some lumber. It's ridiculous. And it's having a substantial effect on the standard of living. A lot of people that are really tight. And if you don't have wages rising at the same as the inflation rate, what happens? You're going backwards, right? And as I said, inflation is a tax on all of us. You don't get free stuff. There's no such thing. All that stimulus money, the trillions of dollars, the money that's being printed to finance our deficit, that's spending money on all these budgetary items that we can't afford, it's not free. And we're paying for it now in inflation. Inflation is what will even it out. And it's a tax on all of us. And many corporate executives, they've been announcing the last few weeks corporate earnings. And in their statement, these companies are saying we are seeing inflation everywhere. And that more price hikes are going to be needed in the months ahead of their products. Here's an example, Shake Shack. They announced another round of price increases. A couple of months ago, they announced they were increasing their prices, and they're going to do it again. 3.5% more in the fourth quarter of this year. Tyson Foods, the top chicken producer in the country, said that food inflation continues to push prices higher. Tyson CEO Donnie King said higher costs are hitting the firm faster than the company can lift prices. And retail prices are set to rise on September 5th. Go buy your chicken. Go buy your beef. Go buy your pork now. Get yourself a big freezer. Because A, prices are going up, and B, there may be some supply problems. Now I'm telling you, and it's going to get really bad. This is just the beginning. Our leaders are doing nothing to stop it. They've decided to create more money, spend more money, and borrow more money. The Fed creates, Congress spends, and the Treasury borrows. So the Senate just passed a $1.2 trillion infrastructure package. We'll talk about that later in the program. It's not really an infrastructure package. And now they're began working on a $3.5 trillion spending package. You know, it seems kind of crazy, doesn't it? That they would continue to do this in the face of inflation. They know they're causing inflation. They just can't help themselves. They don't care. Well, one top Democratic senator actually came out and had some common sense and warned there'd be grave consequences to all the spending. Senator Joe Manchin, Democrat from West Virginia, said Wednesday he had serious concerns about the Senate Democrats' planned $3.5 trillion spending plan, potentially gumming up efforts to move ahead with President Joe Biden's top priorities. They're not his top priorities, by the way. Manchin, in a statement, said that although he voted to move ahead and debate the plan, he was worried about the grave consequences of such spending on the nation's debt, as well as the country's ability to respond to other potential crises. He's going to vote for it. They're all going to vote for it. You'll hear a lot of like posturing and talking, but they're going to vote for it. So my recommendation to you is prepare for the worst. One of the best investments you're ever going to make is food, non-perishable food you could freeze, because you're going to see rising prices on everything, and it's going to accelerate to the point of where I think it's going to get real scary for the average American. And it all started 50 years ago when Nixon took us off the gold standard. All right, time for a break. 732-505-1160 is the call number. That's 732-505-1160. My name's Lou Scatigna. Don't go away.